slash. I think for the first time, oh no, I found hairs that are astray. What I think is the first time I've got both Facebook and YouTube live streaming at the same time. We'll see how this goes. No promises, anyone. But yeah, here we are. Hi. Congratulations, you've made it to this side of the tax deadline. Unless you filed for an extension, in which case it's not till October. In a very timely way, the blog article I was working on for the past period of time was all about accounting. So, hopefully you got like a good night's sleep in between, and maybe you're refreshed and ready to think about this. Or if not, I know this is alive, but it's going to get saved someplace. So like, no pressure. You can come back to it. It's also going to live on my blog if you want to read it. Okay, so today I'm going to tell you about the 7 foolproof accounting truths that every smart small business owner must know. All right, so I get it. Accounting and bookkeeping is a mystery for many people who are launching businesses. And even if you've been operating a business for a while, you might not understand what your accountant is actually doing. Like they're casting magical spells, right? That's what an accountant does. Like just spreadsheets of like, woo, right? Maybe. So no matter where you are in your business journey, your finances don't have to be a mystery. So today I'm going to talk about, I'm starting with a high level overview of like what accounting, bookkeeping is and how it all works. And then I'm hoping the next time you see me, we're going to be talking about specifics about like how to do bookkeeping and how to understand the financial health of your business. But I had to break this up because they're big topics. So your financial accounts, your books, if you will, are a key record to keep about your business. It's proof you show the IRS, but also banks or really anyone who needs to know how your business is doing, how you're doing. I ironically this morning was just reviewing a profit and loss statement that a client brought to me from a business that was not their own, so we're considering buying it. And yeah, it wasn't a great P&L. We looked at it and said, I don't actually know how your business is doing, which is a problem. So this is something that we can learn at any stage of our business journey. Why not now? So something to think about with finances, regularly tending to them, right? That's going to save you a headache come tax time because you'll already be organized and you won't be rushing to the last second like you might have experienced. So that's one piece, but it's also a way that you can understand your finances and make proactive, informed decisions about the future of your business instead of just like, I don't know if I have the money to do that. I don't know if I'll pay bills this month. Like, no, we can know these things. Okay. So I'm a very visual person. This is a visual medium. And yet I don't know how to make this visual exist on your screen right now. I am very sorry for my ineptitudes. I'm going to do a fantastic job of explaining it. Okay. So your books. It's essentially a record of all the money coming, going, moving around in your business. So if you think of this like a flow chart, we have these sort of disparate revenue options across the top here. You've got cash you've received. You've got like a payment processor like Stripe or Square or PayPal. Those are payment processors. They're bringing in money. You've got a bank account. Money is there and coming and going from it. You also might have a credit card for your business, a debit card. You might have cash that you're paying for things. You might have a debit or credit card that you're using to pay for things. Of course, now I find a typo in anyway, it's fine. Okay, so these are all the sort of like moving pieces across the top. We like, as I was describing these, right? Like your bank account has money in it. Your payment processor is probably sending money to your bank account, but like they're also taking a cut, right? So there's like a lot of, and we need to like get it all in one place. So all of these data points, like all of these information sources, need to go into your books. Your books, if you have a QuickBooks account, perfect. If you have a Wave Apps account, I love you even more. If you don't want either of those, you're going to have like a spreadsheet, right? And so we're keeping a record of all the money that came in, whether it showed up in your bank account or not, because if somebody hands you cash and then you spend that cash, that is still technically business income. The IRS would like their share of that. I'm not going to tell, but Okay, so you've got all these different things. We need to like get all those data sources like consolidated, because the money the payment processor brought in that then they put in your bank account, that's not two things that were new money, right? Some of these are like transfers across accounts. Some of it, like a credit card, you're buying it on credit, right? That isn't actually your money. You owe that. So we need to get all of this organized, and that's what your books are trying to do. The other lovely thing that every modern accounting software will do is it will then spit out reports that help you understand what the heck is going on. So in accounting, all these different income streams get categorized into some basic accounts. You've got assets, liabilities, and equity. Equity is also made up of all your revenue and your expenses. Those are my 5. I know the thing says 7. We're getting there. So in accounting, your liabilities plus your equity equals your assets. You can, if you remember some basic algebra, rearrange those and have the same true formula. I say this mostly because some of these categories you're not going to pay a lot of attention to, but I want you to know that they're there. Okay, so have I lost my train of thought? Only a little bit. Okay, so all of those income sources that I was talking about, all those transactions, whether it's like Stripe is keeping that fee and not giving it to me, but they are giving me this, right? All of these things get sorted into categories. These categories are defined by your chart of accounts. If you thought I'd already said account a lot, it just got more confusing. I know, because a bank account is not your chart of accounts, and a bank account could be in your chart of accounts. You see the problem? This is not my favorite feature of accounting. They love to use the same words over and over again until they have no meaning. Sorry, I didn't make the rules. I would change it if I could. So that's why I call them like categories, because that feels a little bit more true. So your chart of accounts, your categories, can be oversimplified or sort of boiled down to these 3 types of accounts, which are the assets, the liabilities, and the equity. Typically also in your chart of account, although technically nestled within equity, are your expense and your income accounts. These are categories of accounts because you can have different income sources and different expense groupings. So if you were starting up a accounting software today, it would come with like a predetermined chart of accounts. Okay, we're going to go over each of these main types of accounts or categories to sort of make sure that we're all on the same page about what they mean. Okay, we're going to start with assets. All right, similar to how this is used colloquially, this is valuable stuff you have. So a nice obvious one is the cash that's hanging out in your bank account or in your wallet. That's an asset. It's also many other things. So that would include revenue you've invoiced but not received yet, store credit you've gotten for something that you returned to a vendor, any inventory or property. Most of you listening to this don't have this happening in your business, which means that you won't really have these in your books. But if you have some, they're going to show up as an asset. Okay. Balance on the other side of the equal sign from assets. Our first category is liabilities. This is money that's not yours. It's money you owe to somebody else. So a great example, credit card, a business loan. Both of these are liabilities. It also includes some other things like sales tax or payroll taxes. So some of my work is now subject to sales tax. So I collect the sales tax when I accept payment from my clients, but that money ends up in my account and it's not mine. The government wants it. So I'm going to have to pay it to them. So that's a liability. It's not my money. I owe it to the government. So liabilities are also something that, like with the sales tax, dear God, please track that for everybody's sanity and for your record keeping purposes. There's also like some of these that maybe are less relevant for small business owners, particularly who are using a cash basis. But I'm trying to let you understand the depth and craziness that could exist. So if you have an invoice from a vendor and you've not yet paid it, technically that's a liability. But that gap between you getting the invoice and you paying the invoice is small enough to be negligible. You're probably using a cash basis. Don't worry about it. Let's just call that an expense. Gift certificates, though, are another thing to consider maybe categorizing as a liability, since you've already made the sale and received the money, but the work, like whatever is redeemed for that gift certificate would be a liability. This is also why you always want a gift certificate to have an expiration date, because then it can leave your books and your gift certificate category in your accounting doesn't just become infinitely larger over time. But I digress. This is another situation where for very small volumes of gift certificates, I would not stress about it, especially if they have an expiration date. Okay, so that's all I'm going to say about liabilities right now. We're going to get into that third of the biggies. This is equity. This is your investment in the business and the results of your business efforts. So let's say you put $100 of your own money into your business bank account, like just to get started. You're like, I know I'm gonna have to pay some money for some things. Let's just throw $100 in there. That means you've made a $100 owner investment in your business. An owner investment is a common category in your chart of accounts. So if you transfer money from the business account to your personal account, whether that's I call take backsies and want my $100 back, or it's, oh, my business is doing so good, I'm going to pay myself $1,000. Those are all, both called owner draw. If you invest $100 and you draw out $100, they zero each other out, right? So you've zeroed out the equity from an owner investment standpoint. But like, we're not here to just move money around like some kind of shell game, right? The point of your business is to make some money, right? So you want it to generate more revenue than it spends. And when this happens, you're increasing the equity. This type of equity is called retained earnings. And a positive balance in your retained earnings is going to hang out until you decide to do something with it. So for self-employed businesses, that probably means you're going to take an owner draw. You're going to go pay yourself, right? For more complex business structures, it's different. This is why I play in the land of self-employment, because it's nice and simpler. So this retained earnings equity category can be thought of as like the umbrella, the big brother. That's not the analogy I want, but like the umbrella for the income and expenses. Both income and expenses are kind of nested in there because your retained earnings is when your income is bigger than your expenses, and it's how much that difference is. So this gets me into income and expense categories. So income accounts, these are just all the ways your business could earn money. The amount should be how much you actually receive from the customer, inclusive of all the payment transaction fees, taxes, direct costs, everything. So if my customer hands me a 20 and I hand them a receipt for that 20, even if it's like this much is sales tax and I know half of that's got to go to my rent, the income is 20. So I could make this more complicated. Because there's a lot of pieces that could be there that like, it may not be intuitive where they land. So let's say I'm selling widgets and I buy widgets for $10 each and I sell it to my customer for $20 each. And then due to local sales tax laws, I've got to add $2 of sales tax to that. And then let's also say that the payment processor takes 40 cents as a transaction fee. So did you follow me? Can you figure this out? How much income would be recorded in your accounts? It'd be the $20 of the item plus the $2 of the sales tax. So $22 is going to be your income. The other numbers, that transaction fee, the sales tax, the $10 you had to pay to get the widget in the first place, those all reduce your income, but they're categorized as either expenses or liabilities. So don't freak out. It's not, you are not going to have to pay income tax on $22. Asterisk. The Washington state government does want you to record your actual grand total. So please file your business taxes with the state of Washington accordingly. So you do want to keep that for actually accurate bookkeeping and records. Okay, let me talk a little bit about the sort of parameters for these income categories. You can have as many or a few of these as you want, more or less. There's a couple delineations that are kind of important. The IRS kind of gets crunchy if they don't get these. So if you're selling a product versus you're selling a service, it's good to keep those in separate buckets, different categories. A purchase of a gift certificate or any form of client credit would also need to be in its own category. But beyond that, you can kind of use whatever categories make sense. If you're like, I want it all in one bucket, I don't want to understand which of my programs aren't doing well, you could do that. I think it's helpful to like put in some categories that like make sense for you, such as I use separate income accounts for my one-on-one coaching, my group coaching, and my Launchpad subscriptions, in large part because each of those are taxed differently. Not completely differently, but there's some differences. Okay, so that's income. Let's move on to expenses. So expenses are what the business spends money on. It doesn't matter if it's tax deductible or not. You've spent money on it. It has to do for the business. You're putting it, charging it to your business account. It's going in your books. So this includes your payment transaction fees, employee pay if you have employees, independent contractor pay if you have independent contractors. It does not include owner draw because that's an equity account. The one asterisk to this is if you are filing your business such that you are on payroll, you would be employee paid, but you can also take owner draws. Talk to your accountant. That's getting a bit into the nitty gritty for what I want to talk about today. So in your bookkeeping, when it comes to expense categories, use what makes sense to you. That is actually the most important thing. It's nice to kind of have that in alignment with the categories the IRS is going to want to know about. So I have provided in my blog article a list of all the stuff the IRS wants. This is also de facto typically included in chart of accounts that are like off the rack from accounting software. But if you want to be really sure, there's a lot of categories here. I don't use most of them for my business. You don't have to spend money in every category. They're there in case you do. You can have more categories than this. I have about a dozen categories that are in the IRS's other expense category, but they're still business expenses, and I need to know the difference between I bought way too many pens this month and that Zoom subscription went up 10% this month, right? So like I'm going to break it out more than what they're going to do. And I would recommend that. Okay, so if everything your business is doing is getting categorized into these 5 accounts, your assets, which are equal to your liabilities plus your equity, and your equity has your revenue and your expenses, right? If all that's organized, your accounting system is going to spit this out in a couple standard ways. The most helpful of this is the profit and loss statement, but there's also the balance sheet, which like that whole little equation I did, that's all on the balance sheet. We'll get into that second. I'm getting ahead of myself. Okay, so you can operate just fine without being familiar with these reports. And it's a lot easier to, talk business with other business owners, particularly with accountants, if you can understand what's happening in these reports. And they're very standardized. So like you might as well learn how to basically, they're also not hard. Like they're not hard. We're going to explain it. So profit and loss is going to be more interesting for self-employed businesses than the balance sheet. But if you ever needed to get a loan or wanted to bring on an investor, they would want to see your profit and loss as well as your balance sheet. So your profit and loss shows all of your income and expenses. At the top are all the different income accounts you've got going on. And then on the right side is what they're totaled as. You can also have a profit and loss where it's like by month. So you can see each month in comparison to each other. Those are a couple standard ones. All individual transactions get totaled by account. And then they're summarized into a total income and a total expenses. And then at the very end of the report, it takes the income and it subtracts out the expenses and it tells you your profit, or typically it's labeled net income. If it's a positive number in the black, you're profiting. If it's negative, then you're taking a loss. Hence, it's very aptly named profit and loss P&L report. So your P&L can illuminate a few things. First off, great place for a gut check. If you look at the value for a category and you think that can't be right, like my business doesn't pay rent. Why do I have stuff in the rent category? Go look at it. If you're using an accounting software, click on the number. It will probably take you to a report of how it got to that number. Accounting systems are great about showing their work. This report, so the profit and loss report, also helps you investigate profit problems. So if that final number on the report isn't the end all be all, right? Like that's just the tip of the iceberg. Is it positive or is it negative? That doesn't help you change the situation. What does is being able to see, like, is it that I'm not earning enough income? Is it that my expenses are too high? Is it one income stream that like suddenly disappeared? These are the things that help you understand why you're not turning a profit or not as much of a profit as you want. That final number in the profit and loss statement, that profit or loss, is what then shows up in the retained earnings equity account that appears on your balance sheet. So, segue. Your balance sheet. This report is actually very simple, and that sometimes people find confusing. So don't overthink this. The report is telling you things you, as a self-employed business owner, already know, but it's an accounting ease. And if you weren't a self-employed business owner, you would need someone to tell you it. So, for example, do your bank accounts have money in them? Is your credit card carrying a balance? Does your business have retained earnings or not? These are the answers to questions that should match what you're seeing on a balance sheet. So this is kind of a big nothing burger by design. The assets will always equal the liabilities plus the equity. So the top half where the assets are always going to equal the bottom half, or else you've done it wrong, except you probably have a piece of software that did this for you, so they're not going to do it wrong. Businesses that are more complex than yours might have more involved balance sheets, right? If you've got substantial loans or investors or like, just other stuff going on, it's going to look different. For self-employed businesses, this should be pretty simple. It should be an accounting of like what's in your bank accounts and credit cards, and then balance on that liability and equity side by how much your business has brought in and how much you've taken out. So owner draws are always negative in the equity. So for those of us who like live off of our businesses, your retained earnings goes up and up and up over time, and your owner draws go negative, negative, negative over time, but they balance each other out. Hopefully, more or less, with some exceptions. So if you looked at your balance sheet and you saw that your bank account had 10 grand in it and you're like, I'm very sure it only has 1,000, that's a sign of an accounting error. That's something worth digging into and understanding and getting it fixed. It's probably not right. It's probably literally just like typo levels of problems. So it's worth looking at your balance sheet, but don't spend too much time there. Okay. This was a lot and only a start. So foundational concepts to like put in the back of your brain and then engage with while you learn more about your accounting and your bookkeeping. So reminder that you're not in this journey alone. I'm here to help, as well as your accountant, your tax preparer, bookkeeper, whoever you're working with. If you need help finding one of those folks, I have a handy dandy guide that I recently uploaded into the Launchpad. So for $17 a week, cancel at any time, you can go see how I think you should pick an accountant and which of the software you ought to be using. It's not QuickBooks. It's Wave Apps. Please go use Wave Apps. It's actually reasonably priced and does the things you want it to do. Ask me how I know. Anyway, but most importantly, don't let perfection be the enemy of done. Take this accounting bull by the horns, learn to understand it. Yeah. And then you can show off to all your business owner friends that you know what a P&L is. Just like that. So like I said earlier, I will more likely than not be publishing another, continuing to talk about this for a minute, because there's a lot of pieces of accounting and bookkeeping that is worth talking about. But these are some foundational bits that are really nice to have as a starting point for understanding on like a really high level how everything is organized and what we're trying to do here. So thanks for joining me, folks. I will probably see you in early or mid-May next. So I hope you have a lovely spring. Okie dokie. Bye. Where's the end? There's the end.